Right now, somewhere in Australia, a family just sold their home for over $1 million, and the suburb they sold it in isn't Sydney or Melbourne. In fact, it's a city that most Australians had written off just 5 years ago. What is happening to this country's property market, and are you on the right side of it? Let's be honest with each other from the start. The Australian property market in 2026 is not one market. It never really was, but this year the gap between cities has become so wide that calling it a national market almost feels misleading. We've got cities smashing records month after month, while others are quietly sliding. We've got renters paying more than ever before, while simultaneously some first home buyers are actually finding windows of opportunity. It's complicated, it's data-rich, and today we're going to walk through it city by city. No hype, no doom and gloom, just the numbers and what they mean for everyday Australians. Let's start where most conversations about Australian property always start. Sydney. Sydney is doing something that frankly seemed impossible not long ago. It's approaching a median house price of $2 million. According to data from Cotality, as of April 2026, Sydney's median house price sits at approximately $1.83 million. Earlier forecasts from KPMG suggested the city could hit $1.9 million by year's end, and based on the current trajectory, some analysts believe it could even breach that $2 million mark before 2026 is out. To put that in perspective, it was only around 12 years ago that Sydney crossed the $1 million median threshold for the first time. We've nearly doubled that. Now, before you assume this is purely good news, consider what that actually means for people trying to get into the market. A 20% deposit on a $1.83 million home is $366,000. That's not a deposit, that's more than some people earn in a decade. The federal government's 5% deposit scheme is supposed to help, but as recent ABC News reporting highlighted in April 2026, the scheme is actually having an unintended consequence, pushing up prices in the more affordable end of the market because it floods that segment with newly eligible, government-backed buyers competing for the same smaller pool of properties. And yet, the auction market in Sydney is showing some fatigue. The city's average final auction clearance rate in April 2026 has been sitting around 51%, the weakest reading since the COVID-19 lockdowns of 2020. So, while values are high, buyer demand at the top isn't as fierce as the headline price suggests. The market is becoming increasingly constrained by its own weight. For investors and upgraders, Sydney still represents long-term capital growth. For first home buyers, the maths is brutal. Melbourne. Melbourne is a fascinating case study in 2026, and honestly, one of the most misunderstood stories in the country right now. For the past couple of years, Melbourne was consistently positioned as the underperformer, the city that got left behind while Brisbane, Perth and Adelaide ran hot. And to some extent, that narrative still holds. The city recorded a minor price decline of 0.9% from its November 2025 peak as of the first quarter of 2026. But here's the thing. KPMG's residential property outlook is actually tipping Melbourne to be one of the stronger performing capital cities across 2026 as a whole, with forecast house price growth of around 6.6% and unit growth of approximately 7.1% for the full year. The argument is that Melbourne has become, perhaps surprisingly, the most affordable of the major East Coast capitals on a median price basis. Think about that. Melbourne, a global city, is now sitting below Brisbane in median dwelling values. That relative affordability is starting to draw attention from investors who've been priced out of Perth and Brisbane. Rental vacancy rates across parts of Melbourne remain very tight, and strong interstate migration into Victoria is keeping underlying demand elevated. The city has had its challenges. Land tax changes, compliance costs, and policy uncertainty have made it harder for investors. But from a pure value perspective, Melbourne in 2026 might be quietly offering the best risk-adjusted entry point of any of the big three East Coast cities. Whether that opportunity holds depends largely on what happens next with interest rates. Brisbane. If there's a city that has genuinely transformed its identity in Australian real estate over the past 4 years, it's Brisbane. What was once considered a secondary market, affordable, lifestyle-driven, and somewhat overlooked, has undergone a structural repricing. As of early 2026, Brisbane's median house price sits at approximately $1.11 million, according to Cotality, with units at around $793,000. Let that sink in. Brisbane, which had a median house price under $600,000 as recently as 2020, is now a seven-figure city. The growth drivers here are well documented: interstate migration, infrastructure spending, the 2032 Olympic precinct developments, and a lifestyle-to-cost ratio that continued to attract interstate movers from Sydney and Melbourne. ANZ is forecasting Brisbane house price growth of around 9.7% through 2026, which would push the median well beyond $1.2 million by year's end. That said, economists are already flagging that affordability constraints are beginning to bite. A city that was once cheap relative to the southern capitals is becoming genuinely expensive in its own right. The rental market in Brisbane reflects this tension acutely. Vacancy rates sit at approximately 0.9%, which is essentially bone dry from a landlord's perspective. If you're a renter in Brisbane right now, you know this reality intimately. Strong demand, limited supply, and rents that have risen substantially over the past 3 years. The post-Olympic window remains a key discussion in property circles. Infrastructure investment is still flowing, but some analysts are already watching for the point at which growth momentum fades. Perth is the city that has stunned the entire country. Full stop. In 2025, Perth recorded annual property price growth of 17.2%, the single strongest performance of any capital city in the nation. That momentum carried into 2026. As of February 2026, Perth's record median house price reached $1,087,862, according to data published by Fair Street Realty citing REIWA figures. KPMG is forecasting Perth to lead the nation again in 2026 with a further 12.8% price growth forecast, meaning the city that sold houses for $500,000 just 4 years ago could be pushing an average well above $1.2 million by the end of the calendar year. The fundamentals underpinning Perth's run are real and structural. The Western Australian economy has been firing on all cylinders. Mining sector employment remains robust. The state's population has grown faster than its housing stock can accommodate, and rental vacancy rates set at just 1.1%, the second tightest in the country. Supply simply hasn't kept pace with demand, and unlike on the East Coast, Perth didn't experience the same frenzy during the COVID boom years, meaning there was meaningful ground to make up. The question everyone is now asking is, how much runway is left? At some point, Perth's affordability advantage, the very thing that drove so much of the interstate and overseas migration into WA, begins to erode. That point is getting closer. For buyers who got in 2 or 3 years ago, the gains have been generational. For those entering now, the calculus is increasingly complicated. Adelaide. Adelaide might be the most quietly extraordinary property story in the country. While it doesn't always dominate the headlines the way Perth does, the data tells a remarkable story. In January 2026, Adelaide house values rose 1.3% in a single month, 4.8% over the quarter, and 9.7% year-on-year, according to OpenAgent citing Cotality data. The median house price in Adelaide, depending on the data source, is sitting somewhere in the range of $983,000 to just over $1 million as of early 2026. Hotspotting's Price Predictor Index for autumn 2026 described Adelaide's property run as unstoppable, noting the breadth and consistency of the demand signals across the city's suburbs. The rental market here is among the tightest in the country. Cogility's April 2026 Home Value Index report noted that Adelaide's rental vacancy rate sits at just 0.9%, the absolute tightest of all capital cities. That figure is extraordinary. For context, a healthy rental market requires a vacancy rate of around 2% to 3% to give tenants any meaningful choice or negotiating power. Adelaide is less than half that threshold. What's driving this? Adelaide has benefited from the same cost of living migration that Perth has seen. People fleeing the expense of Sydney and Melbourne and finding that South Australia offers a high quality of life at a more manageable price point. Defence industry investment, the AUKS nuclear submarine project, and growing local tech sector employment have also added layers of economic confidence that simply weren't there a decade ago. Canberra. Canberra occupies its own distinct lane in the Australian property conversation. It's a city of government workers, diplomats, university staff, and public sector professionals, and its market behaves accordingly. Steady, predictable, and relatively insulated from the dramatic swings you see elsewhere. According to data from Which Real Estate Agent, citing Cotality figures, Canberra's median dwelling value now sits at approximately $892,800 as of the March 2026 quarter, with annual growth tracking at around 6.1%. Detached houses have been outpacing units, rising 0.6% in March alone. Canberra's great challenge, and it's not a new one, is supply. The ACT government controls land release, and that tight control over the development pipeline means housing stock has never grown fast enough to meaningfully ease prices. Unlike cities where migration is a dominant force, Canberra's market is driven primarily by its own working-age population and the reliable income floors provided by government employment. For buyers, Canberra presents a city where you're unlikely to see explosive gains, but also unlikely to see the kind of correction risk that comes with speculative heat. It's a stability play in a year when the rest of the country feels anything but stable. The big picture. What does all of this mean? So, where does this all leave us? Australia, in 2026, is a country with a housing construction shortfall that is getting worse, not better. In the 12 months to March 2026, total dwelling completions across the country were approximately 160,000 to 170,000, roughly 30% below the annual rate needed just to keep pace with population growth, let alone work through the existing backlog. The federal government's target of 1.2 million new homes over 5 years is widely regarded by independent housing economists as both ambitious and insufficient to genuinely resolve affordability. The national rental vacancy rate fell to 1.1% in February 2026, according to SQM research, a figure that represents extraordinary stress across the system. Australia's population is growing faster than its housing supply by a significant margin, and construction cost increases of approximately 40% since 2019, as noted by the RBA, mean that the economics of building new homes remain genuinely challenging for developers. On interest rates, the RBA cut rates during 2025, providing some relief to mortgage holders. But as of early 2026, those cuts have not been enough to dramatically improve affordability, and some forecasters are now watching inflation data closely with rate hike risks back on the table. The statement from the RBA's Monetary Policy Board in 2026 acknowledged that the full effect of previous rate reductions was yet to fully flow through the market. For investors, the two-speed dynamic between high-growth cities like Perth, Adelaide and Brisbane versus the more complex picture in Sydney and Melbourne is where portfolio decisions are being made and remade. For renters, 2026 continues to be an extraordinarily difficult environment in virtually every capital city. And for first home buyers, the single most important variable remains the same one it's been for years: supply. Until the country meaningfully closes the gap between population growth and housing construction, affordability will remain one of the defining social and economic challenges of this generation. This market doesn't reward people who wait for certainty, but it also doesn't forgive decisions made without understanding the data. Know your city. Know your numbers. And keep watching this channel, because this conversation is far from over. If you found this video useful, drop a comment below telling us which city you're watching or buying in. Like the video if this kind of data-driven breakdown is what you want to see more of. And subscribe so you don't miss the next one. See you there.